Hey guys, quick heads up about a free webinar you don't want to miss. It's titled From Severance to Security, and it's happening Thursday, July 24th at 12 p.m. Central. Whether you're navigating a layoff or just want to be prepared before one hits, this session is packed with must-know advice. You'll hear from two employment attorneys and Brenton, who will break down what to look for in a severance agreement, your legal rights and what's negotiable, how to stay financially secure during a career transition, and more. It's totally free and open to all. Just head to newmoneynewproblems.com/severance to save your spot. That's newmoneynewproblems.com/severance. We hope to see you there.
In this episode, we go through a few examples of why clients chose to pay their financial advisor $6,000. Let's get started.
Let's get some money.
From New Money, New Problems, it's the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. Negotiating compensation, purchasing your first investment property, helping your family with money, the highs and lows of entrepreneurship. New Money brings new problems that require new solutions. Join us as we work through them together. I'm Brenton Harrison, and this is the New Money, New Problems podcast.
Hello, my name is Brenton Harrison of New Money, New Problems, and your host for the New Money, New Problems podcast. If you've been listening to our podcast for a while, about a year ago, I did an episode, and the title of it was some version of why you should pay your financial advisor $6,000 or why a financial advisor would charge $6,000. We'll actually put the link to the episode in the show notes. But I did that episode for a few reasons. One of them is because, in my opinion, one of the first things that people should be able to figure out when they are engaging with any professional, but definitely a financial advisor, is how much do you charge, right? Like, nobody likes spending an hour of their time waiting for someone to give them the price and then find out that it's something that they either can't afford or are unwilling to pay. So one of the reasons that we did that episode is to say, hey, here is what we charge, but I want to give you some reasons as to why we charge it. In a part of that episode, I shared some of the reasons why it might be worth it for some people to pay that fee, but I definitely focused more from the advisor's perspective in terms of how prices are set. So I wanted to do a follow-up to that episode and share some case studies of client stories where we can show you the value that can come from having a relationship with an advisor that has more depth, right? Where you're not just talking about a budget, you're letting them into the deep details of your life and hoping that they can add some value. Now, as you can expect, we are not going to give you the exact details of these stories, and we are going to switch up some of the details a little bit. Because as you would expect, if you were one of our clients, you would not appreciate waking up to a podcast episode one day that's sharing your full life story. So we are going to mix up the details a little bit just to give you an idea of the concept of some of the things that we cover in our planning relationships. And then we're going to talk at the end of the episode about whether or not you should leave your financial advisor during periods where there's not intense value added. So let's get started. And case study number one is about the value of having a financial advisor that is overlooking your tax return. And that's what happened in this scenario. We had a client who came in and they had an investment that they were selling after a long period of time, and they were selling it for a profit. Now, we've talked about capital gains on this podcast, and you know that if you have held an investment for at least a year and a day, you pay long-term capital gains taxes on that sale, which are either 0, in most cases 15%. If you're a really high income earner, you pay 20% on long-term capital gains. Now, when it comes to capital gains in a tax return, they are listed on Schedule D of your tax return. It's an additional form for your 1040 that lists the details of what was sold and what the profit was of that sale. And that profit is taken over to your 1040 so that you can see what you pay taxes on. Well, we had been talking to this client about selling this investment for over a year. So we were acutely aware of the value of the investment before it was sold and also their cost basis. Cost basis is a client's skin in the game. It is essentially what allows the IRS to determine what is profit when something is sold and what is simply a return of the owner's capital. So for example, if you sell something for $150,000, but you put $50,000 into it, well, when you sell it, that's not all profit. $50,000 is a return of your cost basis, and you have $100,000 of profit. So because we were well aware of the market price of the investment and also the investor's cost basis, when we reviewed their tax return that had already been filed, we noticed that the CPA had doubled the investor's profit and had not considered their full cost basis when calculating what was shown on their 1040. Now, the client was upset because they had a tax return that led to a bigger payment than they were expecting on that sale. And we were able to go to them and say, hey, we think there's been an error here. Go back to your CPA and give them this information and make sure that they accurately listed your profit. And when they went back to their CPA, they found out that, yes, indeed, they had actually double counted the profit, and it led to a 5-figure return when that CPA amended what they had filed for the client. This is just one example of us not being tax professionals, but having enough knowledge of both a tax return and our client's situation by meeting with them several times a year to be able to tell them to go back to their CPA and ask for them to assess this situation. The next case we'll study is the case of a client who wanted to put a large down payment on a property. Matter of fact, they wanted to put the biggest down payment they possibly could because they were concerned about what their monthly mortgage note would be. Now, we've done full episodes on issues like, should I put 20% down on my mortgage? And I have shared that in most cases, my answer would be no. If you have a strong credit score and you can limit how much you're going to pay in PMI, and you don't know whether you're going to be in that home for longer than 7 to 10 years, I would say keep as much of your money in your pocket as possible so that it can be invested and have the opportunity to earn a rate of return instead of putting a big down payment down on a property. And then the only way you can get that money back is if you refinance it and take equity out of the property. Essentially, once you've put the down payment down, the only way that you can get it back is either selling the property or borrowing your own money back from the lender. But this client was really worried that if they didn't put the biggest down payment on their home possible, that they would have a monthly mortgage note that they couldn't afford or made them uncomfortable, and it would just stress them out. Now, one of the things that you want to consider in times like these is when you have mortgage rates that are slightly elevated. And that doesn't mean that they're like historically high. They're actually right in line with many times in our history. But there is the prediction from most analysts that at some point in time, the mortgage rates that you see now will go down 0.5%, maybe a full percent, and give you the opportunity to potentially refinance a property. Well, it would be one thing if you were buying a house now that you could barely afford and rates were in the 2.5% and 3% range, because then you really are over borrowing, and it's not like you're going to have the opportunity to see rates go much further down than 2.5%, 3%. But when you're getting rates that are 6.5%, 7%, and you know that analysts are predicting that at some point in time they're going to settle in the 6% or 5.5% range, you can reasonably expect that at some point down the line, there's going to be the opportunity to save 0.5% or 3/4 or even 1% on your home loan and give you some real savings on your monthly mortgage note. So what I talked to with this client is first, the benefit of getting multiple quotes on a home loan. Many people get 1, maybe 2 quotes on a home loan, not understanding that the lending requirements, especially when you're talking about what we call non-conforming loans, can vary greatly from one company to the next. So we first talked to them about a 14-day period where we encourage them to get as many quotes from lenders as they can. 14 days because depending on the credit score that a lender is using to check your credit, you would have at least 14 days to check it with as many other entities as possible for that same purpose without it showing up as an additional inquiry on your credit report. So we mapped out a plan of action where in 14 days they would check their credit and get quotes from as many lenders as possible. And we made sure that we emphasized that the mortgages that they were looking into needed to have the ability to be recast. And I don't even remember if we've covered recasting a mortgage on this podcast. We'll likely do a full episode on it. But the premise of recasting a mortgage is if you are signing up for a 30-year mortgage, let's say it's $200,000 over 30 years, your lender's going to calculate a payment that's designed for you to pay the exact same amount every single month for 360 months. And at the end of that period of time, the balance of your mortgage should be $0. Well, the interesting thing about that is a big part of making sure that that monthly payment is the exact payment that's needed is the assumption that you're not making any lump sum or additional payments throughout the 30 years that would make your balance lower than they projected on that payment timeline. This is why when you do things like bi-weekly mortgage payments or making a mortgage payment at the end of the year, that it ends up paying off your mortgage years faster than you expected to pay it off, it's because that payment schedule assumed there was no additional payments. And when you make additional payments, it speeds up the timeline because you're making the same payment every month as well, but you're paying down a lower balance than they anticipated. Well, what recasting a mortgage does is it gives you the opportunity down the line, if your lender allows it, to make a big lump sum payment and recalculate the monthly payments that will be required for the remainder of the term to have your balance as $0. Going back to our example where we have a $200,000 mortgage payment for 30 years, let's say that our lender has calculated a $2,100 a month payment every single month to make sure that at the end of that period your balance is $0. Well, if 5 years into having that mortgage, you decide to make a lump sum payment of $15,000, you can ask your lender to recast your mortgage payment and say, hey, now I owe $15,000 less than you were expecting. I have 25 years left. What would it mean for me to change my monthly payment and still be able to have a $0 balance at the end of that period? And they may say instead of $2,100, you can now pay $1,900 for the remainder of the 25 years and still have a zero balance at the 360th month. Well, if you do that, you're essentially getting one of the bigger benefits of refinancing a property, which is the lower mortgage payment, without formally having to refinance it. So what we told this client was, hey, you are putting a big portion of your net worth down on this mortgage, and you can't get that money back unless you borrow it back and have to pay your lender at interest for money that was originally yours. So why don't we instead find your red line, the highest monthly mortgage payment with which you're comfortable, with the goal of keeping as much money in your pocket as possible instead of putting it towards the down payment. But now when we're looking for mortgage quotes, we can ask them intentionally, do you allow for a recasting of your mortgage? And if it doesn't, we can take them off our list and we can whittle it down to several quotes from lenders who will allow you to recast your mortgage. And that will give you two different opportunities to lower your payment. Either mortgage rates will go down as much as we expect and you can simply refinance your property and get the lower payment that you wanted on the front end. Or if you do it our way and 2-3 years down the line, you don't feel comfortable and you do want a lower mortgage payment, even if it means giving up your assets, you can simply give up your assets at that time and recast your mortgage for that lower payment. So it's essentially buying time for us to see whether the market will take care of their concerns or if they have more comfortability than they expected with a higher mortgage payment. And in either scenario, it would allow them to keep more of their money invested than putting down a large down payment. This next one is a quick one that has to do with the value of having a professional guide you through the insurance process. Now, the interesting thing about insurance is you can get the same insurance policy with an advisor or without an advisor. There are companies out there like Policy Genius or Ladder, where instead of working with an advisor, you can go on this site and you can have access to the same list of companies that you might have by working with a professional. So while that's interesting, another interesting element of it is many people think that by getting it through a professional that they're paying more for the policy. And that's not the case. You are not charged an upcharge by working with a professional. In fact, insurance companies pay a commission to either an advisor on that case or to the website that's listing the policies that is separate and apart from the money that you're paying to secure the coverage. So while there is the opportunity to get insurance without an advisor, you are not paying additional to do so, and you are losing access to the guidance of that professional when you choose to get coverage on your own. In this client's example, what they did was they were trying to get life insurance and disability insurance for their family. They went to one of these sites to try to secure their own coverage, and they had a medical concern that during the underwriting process came up, and as a result of that concern, they were declined for both policies. When they came to us, they started working with us. They walked us through the scenario. They walked us through the medical concern, and we asked them for their permission to fill out what's called a universal HIPAA form. And what a universal HIPAA form is, it's a form that allows an insurance brokerage or an insurance advisor to go out and get doctor's records from professionals where you might have gone to go through issues like the medical concern that this person was having. And after they signed the form, we were able to get medical records from their physicians from these facilities. And by going through these records with an insurance brokerage that we use that has contacts with underwriters at various life insurance companies, we were able to lay out a case for what happened, why it was not as serious of a concern as what it looks like when you say things like, hey, I experienced XYZ in the year 2022. And we asked them, without formally applying, if we were to present this case to them, what quote they would give this person. Would you approve them? Would you not approve them? If you were to approve them, would you make them a standard health class, a standard plus health class, a rated health class, meaning that they would have to pay an additional surcharge as compared to what someone with good health, quote unquote, would pay for that policy? And we were able to get tentative quotes back from many carriers, but the quotes said that we would want additional information from this person's physician. We took that information to the person's physician and we asked them to write a consideration letter on this client's behalf, explaining what happened, explaining the steps that were taken, and whether it was something that was going to have long-standing impacts on this person's life. The physician was able to review the case and say, no, I think that they're looking at something in my records and considering it more serious than I consider it to be. They wrote a consideration letter on that client's behalf, signed it, and we submitted it to the carriers that had given them a tentative quote. And not only were we able to get that person life and disability insurance when they had previously been denied by the same carriers, we were also able to get them a standard plus health class, which means they went from not being approved to being one step above what someone in quote unquote good health is considered to be. So going from being completely denied with one company to having a very reasonable payment for both life and disability insurance that protects your family in the event that you die and yourself in the event that you're disabled with the exact same company, the only difference being doing one application with an advisor and the other application without.
This is the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. We'll be right back.
Are you wondering what new money problems you might be overlooking in your financial life? If so, we've got great news. We've crafted the New Money, New Problems Gap Finder to identify potential weaknesses in your finances in areas ranging from budgeting, investments, insurance, and even the threat your extended family's finances could pose to your household. Please head to newmoneynewproblems.com/gapfinder to complete it today. Again, that's newmoneynewproblems.com/gapfinder to take the assessment.
You're listening to the New Money, New Problems podcast. Subscribe now at newmoneynewproblems.com. Welcome back.
Welcome back from the break. We're going to give you a couple more case studies and then we're going to talk about periods where you don't have a case study and you're still paying an advisor. And the next one we're going to go to has to do with student loans. I know y'all might be tired of me talking about student loans if you don't have them. If you do have them, you're like, yes, more student loans. But this will be a quick story. We've talked on this podcast about income-driven repayment plans in the past. Income-driven repayment plans are plans that ask once per year for you to tell your loan servicer your income, and they use that income to calculate a student loan payment for the upcoming 12 months. And it's important to understand that with these policies or with these payment plans, you have what's called an income-driven repayment plan anniversary, which means this is the time each year that your loan servicer will reach out to you to update those payments. It's also important to understand that if you recalculate your payment for some reason, like you've had a child or you've lost a job or you've had a decrease in pay, you can recalculate it and it will lock in a new anniversary, and you will now be asked on that date every year when to calculate your payment. So we had a medical professional that was working with us. Well, this person had a current student loan payment that was based on one of their years in residency where they were earning about $65,000 and their payment was a little under $400 a month. But the next time their student loan servicer asked for their income, they they were going to have access for their current income of over $350,000, and it was going to increase their student loan payment to over $2,500 per month, which, as you can expect, they were not keen to do. When we were looking at the date that their loan servicer was planning to reach out, it was August. So in August, if you think about the timing of the year, if you have filed your tax return by April 15th, by August, your loan servicer will definitively have access to your most recently filed tax return. Well, based on the timeline of residencies and fellowships, they end in June or July. So for this person, when their student loan servicer looked at their tax return from the previous year, they were going to see a tax return that reflected half of the year where they had earned about $30,000 to $35,000 that last 6 months of their residency and fellowship. But the second half of the year would show about $175,000 worth of income. That's not something they wanted to see. Well, one of the times that you can ask for an update of your payment is when you have switched jobs. So we took advantage of the fact that this person had switched jobs in the early part of the year before their most recently filed tax return was available. So when their payment was recalculated and the loan servicer accessed their most recently filed tax return, instead of accessing their 2024 tax return that showed about $200,000 of taxable income, it would instead access their 2023 tax return that still showed one more year of residency pay. When we did this, it allowed them to lock in a monthly payment of just about $400 a month for an additional 12 months. And if you think about this, because of the fact that we're doing this before the most recently filed tax return is available, in the following year, instead of seeing their 2025 tax return that shows a full $350,000 of income, it's going to show the 2024 tax return that shows their $200,000 worth of income. So they would really get 2 full years where they had a significant reduction in payment as compared to what they're actually making, just by their advisor having an understanding of how income-driven repayment plan anniversaries work and the benefit of using those rules to reset the timeline of when your payment was increased. I have one more story for you, but instead I'll save that for another episode. And let's talk about if you're in a situation where maybe at one point in time with your advisor, you've had an intense period of value, and maybe now it's in year 3 or 4, and you're not having those periods where your advisor is finding that your CPA double counted a capital gain, or you're not able to save, $2,000 a month as compared to what you would have paid on the student loans, and things in your life are just kind of static. They're not changing much. And we have many clients in that situation where they'll say, should I continue paying you? Should we continue working together when there's not really anything that's changed this year as compared to the year before? Well, I got to be transparent. When people ask me that, internally, what I'm thinking is if they're the type of client who was going to have a $2,500 student loan payment, and instead we negotiate a $400 a month student loan payment, I'd be thinking, well, we saved you like over $24,000 in a single year. I would think that maybe we undercharged you when we charged you in that year, and it should be okay to have a year where a whole lot doesn't change. But that's not the exact conversation that we have. What I do tell people is the value that you get from a financial advisor is not always going to be linear. There are going to be periods of your life where you have so much going on that you're meeting with your advisor more frequently. You change a job, you have a child, you lose a parent, you decide that you're going to sell a property or buy a property. Those are periods where you're going to meet with your advisor more often than usual, and it's going to be a period where your advisor is going to be able to show you some value that is probably undercharged as compared to what you're paying them. But that definitely does lead to periods where once you're in that home, you're going to have a stretch where it's like, well, we're in the home. We're not moving for another 3 years. My compensation isn't changing. What now? And there is still benefit to having the oversight of a person who can see ahead, can understand your goals and your priorities. And maybe you do have meetings for a couple of years where you're just kind of checking the boxes, dotting the I's and crossing the T's. And that's perfectly okay. Because one of the benefits of having a long-standing relationship with an advisor, even if the value is not the same in every single year, is that when life changes again, you don't have to catch that person up to speed, and you don't have to reestablish a relationship with an advisor who is making sure that all of their recommendations are in lockstep with what's important to you. Now, does that mean that everybody needs a financial advisor? No, everybody doesn't need a financial advisor. Does it mean that everybody should pay $6,000? No, that's a big part of why any professional is going to make sure that they have a target market that in terms of income and interest align with how they offer their products and services. So you definitely have to find the right fit in terms of temperament, in terms of price, in terms of services offered, and depth of planning to make sure that relationship fits your needs. But the point of this episode was to give you a few examples of some periods where having the oversight and partnership with that professional can add to your life above and beyond what you were charged. I'll see you next week.
From New Money, New Problems, this was the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen.